Hello, everyone. Dave Keller here with StockCharts.com. Thanks for joining us today for this special event on rotation. When I do a lot of media interviews recently, I'm often asked about rotation. What does that mean? What's happening? How do we understand what's working and what's not? And we thought we'd get together some of our top experts here at StockCharts TV, put our heads together and share with you how we are perceiving the current leadership rotation, what charts, what themes are standing out to all of us. I want to welcome on my two guests, Grayson Roze, who's the VP of Operations here at StockCharts, host of StockCharts in Focus. Also, Julius de Kempenaer joining us from Amsterdam, who's the host of Sector Spotlight and the founder of RRG Research. Gentlemen, thanks for talking rotation with us today.
Good to be here.
My pleasure, Dave.
So, as we were talking before we start the broadcast, right? And a lot of the questions I know I've been getting, and I know you guys have been too, has just been talking about rotation. We've had things that have been working and all of a sudden that changes. And it's a period of uncertainty for investors. They kind of struggle a little bit with trying to understand how they should be positioned and what they should expect through this. Julius, let's start with you. You're the founder of RRG Research. You designed this great visualization to help us understand rotation. Let's start there. How are you interpreting the current environment?
Yeah, if we look at the RRG that you have on the screen right now, there's a couple of things that catch my interest. Most importantly is the rotation for three sectors, three pretty big sectors that are rotating into or inside the lagging quadrant, and they are healthcare, discretionary, and technology. And those three sectors make up more than 50% of the S&P 500. And they are now all moving into lagging, which means that the relative trend versus the S&P is down. Now, that doesn't necessarily mean that the index is going to go down or that these indexes are going to crash, but they are underperforming the bigger market. And if more than 50% is underperforming, you need a hell of a lot of positive pull from other sectors with smaller weights to actually keep the performance of the S&P up. And if we look at what's doing well right now, then we're looking at real estate, we're looking at industrials, we're looking at financials and energy, they're way out to the right, and communication services. If you add up the weight of all those sectors, and it depends a little bit on what you want to add. If you want to leave out energy and financials because they've already rolled over and start to lose a little bit of momentum, then it's pretty much just over 20% that's pulling in the right direction. If you add energy and financials, then we're talking just below 40%. So all in all, the trend in the S&P is still up. There is no doubt about it. As a matter of fact, April, from a seasonality point of view, is actually a pretty good month for the market as a whole. But I'm a little bit worried. It makes me cautious that three of these important sectors are rotating in a negative fashion. Now, there's been I've written some articles recently about the difference in rotation between large cap, which is what we're looking at right now, and equal weight or small caps. And there's actually two sectors where that made and makes a difference. And if we start with the technology sector, then we can see that on the equal weight that you have right now, technology is actually also rotating into, if you highlight the line in the table on RYT, then we can see that instead, there you go. So now you can see that rotation nicely moving into the lagging quadrant. And a similar type of rotation is happening when you move to the small cap version of these sectors. And you will see that the ticker symbol is actually PSCT. And there you go. It's in weakening, but quite rapidly heading towards lagging. So where we had a situation a few weeks ago where it was predominantly the mega cap, large cap stocks inside the S&P in the tech sector that were weakening, that weakness is now getting broader participation, as we can see from the equal weight and the small cap technology. So that makes me cautious on the technology sector as a whole. And because technology is such a big chunk of the S&P, I think it will have an effect on it. If we switch to the discretionary sector, then we see on the large cap version, we see the tail of XLY moving into lagging. You can stay on this one here and highlight discretionary, then, oh, you're already there. Okay. Don't worry, we'll talk about it.
I made it.
Here's small cap, so go to discretionary. Then you will see that it's inside leading and moving further into leading. So this is actually a pretty good rotation for consumer discretionary small cap. Now compare that with XLY on the large cap, and you'll see that it is moving, there you go, it's already visible there, into lagging. So these are opposite. So this tells us that in discretionary, it's still predominantly the big names. So that's Amazon and Tesla, obviously, that are dragging it down. And the smaller names are actually doing pretty well. So discretionary as a whole is actually doing pretty well. But in the large cap section, it's dragging it down. Now, obviously, because XLY and XLK have such a big impact on the market as a whole, I think they could hold us back so that 75% of the time the S&P goes up in April. That may still very well be the case. It's just a question whether it's going to be a 3 or 4% raise or 40 basis point raise because of this, what we just discussed.
It's such a great point. And again, we love to talk about the market in terms of like a binary outcome, right? Are you bullish or bearish? And you're implying, are you like all in, the market's going to go to the moon, or all out and the market's going to go to zero? And what you're illustrating to me is not necessarily that the market's going to go down, but what's the upside if you have some of these larger sectors that are weighing things down? Is that fair?
Yeah, that's very fair. And I also, I think your assessment is very accurate. To add to that is when I think in terms of corrections, I don't necessarily think that it means a price decline. I think if you just imagine a trend channel with a series of higher highs and higher lows, you can move from a high that touches the upper boundary to a low that touches the lower boundary. But I think you can also have a correction that moves sideways. So you hit the upper boundary, market goes sideways, and after a while you will hit that rising support line. So a correction, in my mind, doesn't necessarily equal a decline in price. It can also be a correction in time, and then we hit that support level, and basically the market has just digested that supply that hit it, and there was enough demand not to let the mark sink too far. But there you go.
Yeah, that's a great point. You brought up the word I was going to just mention, which is digestion. I always call periods like this digestion periods. Like you have a big meal, you need to digest it, and that's sort of what the market is doing in a somewhat painful and volatile way. That's sort of where it's headed. That was awesome, Julius. Thanks for walking through that. I mean, I've used RRG, as you know, for a long time. If you want to understand how things are rotating, I would start there as always. The next thing I tend to do, and I'll walk through some of my charts, and then Grayson, we're going to come to you and talk about some stock specific ideas. For me, when I'm thinking of rotation, I immediately then go into ratio analysis. And what I learned, from my time at an institution was, understanding the ratios, understanding what's working relative to other things, and how different asset classes, different markets are related is arguably one of the most important things you can do, because you want to own things where the line that you own is going higher than the line of what you don't own, or what you're overweighting is outperforming what you're underweighting. So I've learned to look through ratios. This chart list that I'm going to share with everyone is part of my morning coffee routine. So if you go to the chart packs on your member dashboard, go to the chart packs point below all your chart lists. There's a little gray button, and you can get to these charts among many others. I'll start with, when you were talking about, Julius, the equal weighted versus cap weighted, one of the ratios I look at all the time is the equal weighted consumer discretionary versus equal weighted consumer staples. That's what's in blue at the bottom. At the top, it's the normal cap weighted version, the XLY over the XLP. And usually these things move together. So coming out of the March lows, you had consumer discretionary leading on both sides. And that makes sense because you have offense over defense. And and that's a pretty logical assumption to make in an uptrend. But you can see how that all changed there at the beginning of February, where the ratio at the top went from an established uptrend to more of a downtrend. Now, the XLY, as you guys know, is really weighted into Amazon, Home Depot. Those two stocks are probably 35% of that ETF. So when those things are struggling, the ratio is going to come down. The equal weighted version has continued higher, but it's just started to roll over a little bit. And it's not the end of the world. And it could be, to your point, Julius, maybe the lower end of a channel. I'll be curious to see if this bounces higher or not. But overall, weakness in that line at the bottom tells me to start thinking more defensively. And when I'm thinking of rotation, I'm immediately thinking in my mind of a bunch of charts and consumer staples that don't look that bad. Things like Kraft Heinz and Hershey, and stocks that we probably have not thought about in a while because they've just been underperforming, are actually starting to emerge a little bit. And that's one group that I'm certainly looking at. The relative strength of semiconductors, that alone, if there was one indicator I probably had to understand rotation, this might be it. Because in general, when this line is going up, the market can't be in that bad of shape. When this line is going down, I start to think a little more cautiously. It came down heavily from mid-February to early March, and that's when you had the bearish engulfing patterns on semiconductors and a lot of other things as the momentum kind of came out. These have all bounced a little bit right now. We're seeing technology jump pretty good while we're recording this at the end of March. So it'll be interesting to see if that's a counter trend bounce before further underperformance, which my gut tells me is probably what we're seeing here. One of the ratios I've looked at for a while is financials versus technology. And the reason why this is such a great ratio to look at is because for years, I'm talking multiple years, this has been in a downtrend. And arguably that changed on September 1st, 2020. This is when I would argue this ratio has bottomed and potentially for a long time. Financials have always been underperforming technology because you have very low rates, and technology has been the juice. That's what's been leading higher. From September on, though, you're better off owning JP Morgan than you're better off owning a technology stock, which is unusual. That's not an environment that I think a lot of investors are used to. And now that has a lot to do with rising interest rates and whether you think that they could go higher from here. But if you think there's further upside in rates, if you think there's further downside for bonds, that ratio overall has been pointing away from technology and into financials. This is to dig a little deeper in financials. One of the ratios I like looking at is regional banks versus mega cap banks. And it's sort of a play on small versus large, because regional banks, obviously smaller companies, smaller exposure, less international exposure. But what we're actually seeing here is this is rolling over a bit. Regional banks had really dominated from September into February. What this tells me is it's not necessarily that regional banks don't look good, because I think they still are holding up okay. It's that the rest of financials all are starting to emerge pretty well. Pulling back a little bit, obviously, as rates have paused, but overall, it's a pretty good chart to look at. When I'm thinking of rotation, Julius mentioned, market correcting in time. And I think what's interesting is when we think of the market as binary, up or down, we're forgetting that third direction, which is sideways. And one of the ratios that I look at is consumer discretionary versus technology. This ratio at times has seen one sector favoring the other. If you start the clock at the March low of last year, for the last 12 months, literally you have gained nothing by owning one of those sectors over the other. They are the same sector. Now, this is cap weighted. So it's basically, do you own Amazon or do you own Apple? And overall, what this ratio is telling you is there's no real benefit weighting between those two sectors. It's more of an it's an all or nothing play. You own those or you don't. And what it also tells me is to look further down, look at some of the smaller stocks that may be emerging in those sectors. The last thing I would mention in terms of ratios to try to make sense of leadership rotation is the momentum factor. A lot of people use this as a proxy for just trend following. And I would tell you the challenge with any sort of model like this is the ETF called MTUM. And anytime you have a model, you rebalance it. You don't rebalance it every moment. You rebalance it once a month or once a quarter, once every 6 months even. And what happens during a rotational period is the momentum ETF starts to struggle, because what happens is it's still owning the names that had been leading, and it hasn't had a chance to rebalance into the new stuff. So what this ETF owns right now are things like Tesla and Apple and other stocks that had been fantastically outperforming and then kind of came down to earth. It's not been able to rotate into things like financials and energy. There really aren't big weights in here yet. So I think what happens when you can tell the market's rotating because the momentum ETF will plunge pretty quickly because there's new leadership. Eventually this catches back up and the ETF starts to perform pretty well. And again, I think for trend following, I think trend following is just fine. It's all about a question of tactically understanding when those rotations are happening. So that's how I break things down, guys, from a ratio perspective. And again, I like the idea of starting with the RRG and making sense of the rotations, going into some ratios to try to tease out some of the themes a little bit more. Grayson, let's go to you next. I mean, what I like about what you brought to this as we were talking about what to review is more of a bottom-up exercise, right? Let's actually look for what's working and see what themes come out of it. It'd be interesting to hear what is on your list of names relative to what we've talked about so far.
Yeah. So, first off, I love a lot of the stuff that you guys are saying, and it's fun to think about that in the context of what I'm seeing in the markets. Really quick, the list that we're going to run through briefly here is 10 stocks that, from my perspective, are setting up really nicely. They're interesting setups, potentially actionable setups, and they're generated from a list that I put out on Twitter every Sunday. I call it my little 10 I'm stalking list. A lot of the things that I end up going and actually buying are generally come from this list. They're not recommendations. Everyone's got to do their own research, but they're just interesting stocks that are working, which is great in the context of the conversation that we're having today, because we're talking about rotation and what's working. One of the things that was coming to mind as you guys were both talking was, since we're going to look here in a second at kind of the bottom up, like you said, David, looking at the stocks, individual stocks that are actually working. When I think about this concept of rotation, I think about it differently depending on which angle I'm coming from. So when I'm sort of at the top of the market, thinking about what's happening in the market overall, digging into some of those ratio charts, looking at my RRG charts of what's rotating and things, I think about it as rotation. When I think about it at the market level, the top level, I think about it as rotation. When I get down to the individual stock level, though, it's the same concept, but in my mind, I phrase it to myself as what's working. Because realistically, when you're thinking about rotation and you're at that individual stock level, what you want to find is what's working. The most important thing is relative strength, which on all these charts that we're going to look at here today is the top line on my charts. It's the blue line. What we're looking at there is the individual stock relative to VTI, which is the total US stock market. So if something is outperforming the market, that's working. That's what we're rotating into. But I hadn't really thought of that before. When I'm thinking at the top of the market, I'm thinking about it truly as rotation, but I think that's intimidating to a lot of people. And so when I get down to that individual stock level, I really just think about rotation as what's working. I kind of phrase it differently to myself. When I run through these charts too, a lot of these are generated from two different things. One, I spend a lot of time working with our sector summary tool, which allows you to actually drill down from sort of the top of the market into the individual stock level. So we've done this on a lot of shows. We've covered this. I know, Dave, you use it a lot too. But that allows you to actually start with the sectors, click into each one, into the industry groups within, and then down to the individual stock level below that. So I spend a lot of time with that tool going through from the top level down to the individual stocks. But I also run scans every week, which is actually generally where this list comes from. I run scans every week for new 52-week highs. I run that every day after the market closes. I put the results into the same chart list. And so by the end of the week, what I'm left with is this big chart list that I have to work through on Sundays. That's everything that made a new 52-week high that week. And it's fun when I compare those, they end up with the same result, even though one's sort of coming from the top down. And like you said, one's coming from the bottom up. When you're looking at just the individual stocks, you're sort of coming from the bottom up. But they really do meet in the middle, because what ends up working is always going to be making new 52-week highs generally. So it's interesting to think about that. Some of the things that have been kind of running through my head as you guys have been talking. But we'll run through some of these names really quick. One of the things that sticks out to me too, there are still pockets within some of these sectors that are not working. For instance, technology. I mean, the first name on this list is a technology company. Aero Electronics is electrical components there. But heavily outperforming the market and breaking out to new 52-week highs, been consolidating for a little while. There are still pockets within technology that are working, little individual stocks that are sort of ticking away and moving to new highs. This was one that caught my eye recently, Aero. Again, breaking out of that consolidation range and moving up into new highs. Strong scooter on that too. But when we think about some of the other names that are working as we get through this list, there are a lot of industrials, a lot of financials. One that's been sticking out to me is trucking, which has been an unbelievably strong group. I mean, really, I could put this list together with 10 trucking names and it would be a great list of setups. There are so many setups in that space. AutoZone, though, is another one that's on the list. A little bit overheated. I think this is a little bit ahead of its skis, but very, very strong relative strength in the last couple of sessions, last few weeks. Really bounced off that 200-day to new highs quite rapidly. So I'd be looking for this to kind of reset a little bit, but just a consumer discretionary name there might be a little bit of a reopening play too as their stores start to open up. Below that, we get into one of those trucking names, the industrial names in the trucking space. This one is Knight Swift, breaking out to new 52-week highs, been consolidating, sort of bouncing around for the last couple of months. But really setting up nicely. Relative strength line starting to turn around. I love to see that. And this is in a space, in an industry group and a sector that's outperforming the market. So a really, really strong group there in trucking. A lot of setups that I'm seeing there. Clearly some rotation into those names. Below that, a financial name actually. This one's was kind of funny because there's so many people saying the NASDAQ is just falling apart. Tech is totally falling apart. But the NASDAQ itself, the company, is actually setting up beautifully, obviously in the financial space, but outperforming heavily. Kind of broke above that level that it tested pretty heavily, around the mid 130s. Bounced off that sort of twice after making a breakout through it and continuing to move up to new highs, really riding its 20-day and heavily outperforming the total market. So an interesting one there in the financial space. Again, there are pockets in that technology group that are still working. One of them is Paychex, which is technically technology. It has a little bit of a financial component to it in the sense that they do HR and billing and that kind of things. But a great setup here. I love the breakout, the retest, and the bounce up to new 52-week highs again. And the same concept, we're seeing this really working, outperforming the total market there on the top line. Great accumulation on this over the long term too, which is really nice to see. Dave, you and I before the show were talking about Restoration Hardware, which has just been an incredible performer, especially off the March lows. Got hammered so heavily in the pullback, but has just rocketed higher, continues to move up, continuing to outperform really, really heavily. So a great setup there, another discretionary name there. An industrial name here with Rockwell Industrial Machinery breaking out to new 52-week highs. I love kind of the wedge setup here. And again, same concept, relative strength outperforming the total market. Below that, another kind of reopening name, Starbucks in the discretionary space. Breaking out to new 52-week highs, has a little bit of that reopening component and continuing to lead the market. Some of these stocks, it's interesting to see them have gone really nowhere for 2 years. Starbucks is kind of in that category and now starting to break out. So when you think about kind of the power of that base and something that could really rocket even higher, Target falls into that same category, actually has been pretty strong though. Obviously, with a lot of online shopping and things like that and supplies. New highs again, strong relative strength, which I love to see. And then another trucking name is the final one on the list here in Werner. Similar setup to Knight Swift, breaking out to new 52-week highs, a very, very strong industry group, a very strong sector. So clearly a lot of rotation into some of those industrial names. That's been one of my favorite sectors to find some strength in. And trucking overall has been just a monster. Old Dominion was one that was almost on the list here that's just been trending for so long. The weekly chart on that just over the last 5 years has been a thing of beauty, but a lot of other trucking names now catching up to it too. So
it seems
a lot to find.
When trucking names are doing well, things can't be that bad, right? If they're expanding and going to new highs, that seems like a net positive to me, I would say overall. So guys, this has been awesome talking about rotation. We're all approaching it from a little different way, which I think is really valuable. But I mean, I know when I'm hearing both of you guys speak, I see a lot of similarities in your process with my own. I think there's a lot of overlap between, how we all look at the markets. Just to wrap up here with this event, I'd love to just ask each of you. We've looked at a lot of charts now, right? We've looked at a bunch. And Julius, if we can start with you, if you had one of them to focus on right now to try to make sense of this period and navigate it, which one would it be? And I will grant you an RRG, which is understandably like 100 charts in one, but what would be the one thing you would have in front of you to try to make sense of what we're seeing here?
I think it would be the equal weight RRG, because that gives me a little bit broader understanding of the market, not influenced by only a few big names. So if you want to get a good understanding of what's happening in the broader market at a sector level and the rotation, then I think the equal weight RRG will give you that answer, and a good starting point for further research.
I love that because again, I probably oversimplify too much. I always look at the cap weighted version 90% of the time, but again, there are a lot of overweights in there, right? You're looking at a small group of stocks and how well they're doing in a lot of ways. So that's a good point.
That's true, but the thing is, I also look at that chart, cap weight, but
but you only get one, Julius. You get one for this exercise. Equal weight it is. Grayson, how would you answer that? What would be the one thing you would have in front of you to try to make sense of it?
Yeah, I'm going to steal one of your charts, Dave. The semiconductors versus the S&P 500, it sticks out to me. There's so much captured in that chart, so much of the story that we've seen, so much of what's happening in the market, I think is actually captured by that simple ratio. And if you, I don't know if you're able to pull it up really quick, but what Julius was saying too about kind of what actually defines a correction, I loved that. And it applies so clearly in that semiconductor space. Because if you actually draw a trend line, the 50-day kind of almost does it for you there on the chart. But if you actually draw a trend line across this, the uptrend is continuing. We've just gotten so far ahead of our skis there on semiconductors getting so strong. And really what we've done is pulled back in an aggressive way, but to sort of that trend line support. So I think this ratio captures so much of what's happening in the markets right now. And actually gets me pretty excited. Especially to see semiconductors bouncing a little bit now, but that would be my pick, I think.
I love those picks, both of you. I will take advantage of the fact that assuming I already get your two charts, so I have to pick my own, I get three because I went third. I would say the equal weighted consumer discretionary versus consumer staples. And again, it's not a perfect measure, but that is one that Bill Doan, who's one of my predecessors at Fidelity, he had a chart of offense versus defense in the chart room. And it was just one of the go-to charts everyone would look at just to see, where are people leaning? And that alone would help you sort of make sense of the rotation. So it's similar, probably, Julius, to what you said. I think equal weighted versions are really important right now because I would not be surprised to see small caps continue to do well. And I think the more you focus on the broader universe, probably the more opportunity you're gonna give yourself. We only have about 2 minutes left, guys. What's your big picture take from here? Take us through the next couple months. What's your, how do you see things playing out? Grayson, why don't you start?
Yeah, I think that, like you were saying before, kind of both of you, people love to either be full on, I am so bullish, market's going to the moon, or I am full on bearish, we're crashing, we're never going to see these levels again. And I think a lot of people love to gloss over the kind of lame case of market goes sideways. But in a lot of ways, I think that's it's just forgotten by a lot of people. But I think that could happen here. I think that this is a market that's gone so far, so fast, coming off those lows that we saw. We've had so much volatility. I think a lot of investors are just kind of burned out. So a market that sort of starts to rotate, starts to bring more pieces back into play. A market that lets tech cool off a little bit and just kind of drift sideways actually makes a ton of sense to me.
Yeah. Julius, what do you think? Any closing thoughts on what you're seeing now?
My longer term view is that we're still in an uptrend with the market as a whole. And as I explained earlier, I think we need some form of a breather, whether that's going to be a decline in price terms or in time will tell. That's a nice phrase. But I'm not bearish. I'm not all out bearish. I'm long-term bullish, and I think we need to go through some sort of. It's the rotation that we're seeing. It's the rotation that we're seeing that will eventually pick up again and bring us to higher levels.
It's great takes, you guys. The only thing I would add is I think, Grayson, as I was seeing when you were talking, it reminds me of what I was told from some of my mentors at Fidelity. It's not a stock market; it's a market of stocks. And if we spend all of our time thinking what the S&P is going to do, I think it's going to be frustrating and choppy. And I think 2021 is looking a lot like 2010, sort of like a choppy year that finishes positive, but a lot of confusion along the way. But there are plenty of charts, as you highlighted, Grayson, that are working. So as always, lean into what's working, lean away from what's not. And I think we're going to survive things okay. Guys, this was a blast. Thanks so much for giving us some time today. Grayson Roze, Julius de Kempenaer, a pleasure to talk with you guys as always.
Hey, Grayson Roze here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.